Hello, good morning and welcome to A World Economy. Multiplicity of conversation on world economy indicates that Japan is setting up investment facility to back U.S. tariff deal. Welcome to World Economy. My name is Blyden Oken. On World Economy today, Tokyo announced today it will establish an investment facility at a state-owned Japan Bank for International Corporation, JBIC, to support a $550 billion investment package on a tariff deal with the U.S. The package detailed in a recent memorandum of understanding targets sectors including chips, metals, pharmaceutical, energy, shipbuilding, with investment plan through January 2029. The country's finance ministry said the package will include equity, loans, and loan guarantees from JBIC and Nippon Export and Investments. The new facility will help fund overseas expansion by Japanese firms in industries critical to Japan's economic security. A multiple need that comes with it indicates the possibility of businesses and the driving factor in businesses and the beauty of it. Our multiplicity of the conversation states that the ministry also revealed JBIC regulations to expand its investment scope in developed countries including automotive and pharmaceutical beyond previous limits that had applied more restrictively than the emerging markets. As you're looking at a world economy, up next would be Japan's unemployment rates. We'll go on a quick break, and when we're back, a world economy continues. Welcome back. Still looking at world economy. The French unemployment inches down. The number of registered unemployed in mainland France fell by 11,700 people to 3.022 million in August of 2025, holding the pullback from the three-year high at the start of the year, but steadily above the lows through 2023 and 2024. The drop from the previous month was owed to lower unemployment among core-age individuals and those aged above 50 years. In turn, unemployment rose for those aged below 25 years, and that is at 18.9 to 507,000. And now to Africa, looking at insurance in Africa. Kenya's insurance sector has experienced a remarkable turnaround in profitability over the past 7 years, recording a 143% growth in profit after tax between 2017 and 2024. Despite severe setbacks in 2018 and 2020, when profits fell sharply, the sector has since rebounded strongly, posting consistent growth from 2021 onwards. By 2024, profit after tax rose to 33.1 billion KN shilling, more than double the amount for 2017, highlighting a resilient recovery trajectory. And now looking at the charts indicating the total profit after tax in Kenya's insurance sector from 2017 to 2024. According to the figures you're seeing here, as at 2017, looking at the total profit after tax in Kenya insurance sector by 2017, indications stood at 18.6 billion shilling, dropped a bit in 2018 to 7.3 billion shilling, went back up to in 2019 15.1 billion shilling, and after falling another low within the COVID period in 2020 at 6.4 billion KN shilling, began to rise consistently every year in 2021, 2022, 2023 and 2024 to a peak level of 33.1 billion KN shilling. Still in Africa, Botswana's economy suffers deeper contraction in the second quarter. The economy of Botswana plunged by 5.3% year-on-year in the second quarter of 2025, extending the downturn into a sixth consecutive quarter, following a revised 0.4% decline in the first quarter. And this was the steepest economic contraction since the second quarter of 2020, as a prolonged slump in diamond demand pressures the economy. The mining and quarrying sector tumbled 37.8%, mainly due to a 41.3% drop in diamonds and a 2% decline in coal production. Other negative contributors included diamond. Looking at negative contributors, diamond traders, water and electricity and manufacturing. All other industries recorded solid growth except construction, with marginal growth of 0.3%. On a quarterly basis, the GDP slumped by 3.6% in the second quarter, the most since the second quarter of 2020, after a revised 0.2% decline in the prior period. And now let's look at FX updates. As top currency losers, a Turkish lira are falling negative 0.25% and the dollar index dropping a negative 0.19%. Gains are led by British pound 0.23% and the euro 0.16%, as well as Japanese yen 0.08%. Let's go to the market, FX market, and look at the price of the currencies. In the FX market this morning, a Euro USD market, a price level stands at 1.16 point mark, which indicates $1.16 equaling €1. In the market, again for the euro, 0.15%. At the pound against the US dollar, a price stands at $1.33 to the pound gaining 0.25% against the US dollar. And the Aussie gaining, or rather the Aussie is falling, but not of a significant change against the US dollar. The price level of 65 cents to $1 Australian dollar, and New Zealand dollar also gaining, but no significant change over the US dollar. Japanese yen against the US dollar against the Japanese yen at 149 yen into the $1 US dollar. The dollar falling slightly, a negative 0.16% against the Japanese yen, and US dollar against the Chinese yuan. Price level is 7.14 yuan to the $1 US dollar. The dollar gaining, but no significant change in the market, as well as the Swiss franc, a price level at 0.79 franc to the US dollar. The dollar falling against the franc and also falling slightly, but no volatility in it against the Canadian dollar. Let's look at further FX markets. For the FX market, the price level of these currencies and speculative tendencies that comes with these currencies. Now let's look at the FX market as it stands. The US dollar against the Canadian dollar, price level standing at 1.39 Canadian dollar to $1 US dollar. The dollar not gaining, dropping slightly against the Canadian dollar, and the US dollar against the Mexican peso, 18 peso equaling $1 US dollar. A dollar falling against the peso, dollar also falling against the Indian rupee at 88 rupee to a dollar. At the Brazilian real, 5.34 real to the US dollar. The dollar falling a negative 0.3% against the Brazilian real. Similarly also falling against the Russian ruble at 83 ruble to $1, the dollar falling by negative 0.3%. And we're talking about Korean won at 1,409 won to the US dollar, a dollar gaining just slightly 0.05% over the Korean won, and the dollar index are falling this morning. The SY dollar index falling this morning by negative 0.21%. Still within the context of the market, the U.S. futures are waver. Now to the equity market. U.S. stock futures hovered around the flat line today as traders awaited the highly anticipated PCE report and digested fresh tariff developments. The inflation data is expected to influence bets on the Fed's policy path. Following stronger than expected GDP growth and lower jobless claims that slightly reduced expectations for rate cuts. Markets still anticipate the Fed will lower the federal fund rates by 25 basis points in both October and December. On the trade front, President Trump announced a 100% tariff on branded or patented pharmaceutical products starting October 1st, unless manufacturers build plants in the U.S. Additional measures include a 25% duty on heavy trucks, a 50% tariff on kitchen cabinets and bathroom vanities, and a 30% tax on upholstered furniture imports. In pre-market trading, Eli Lilly rose about 2% and Pfizer gained 0.9%. Trump also advanced plans for American investors to acquire TikTok's U.S. operation from its Chinese owner, ByteDance. And now to the markets, looking at global company stocks in the market. Global company stocks beginning with price of Apple this afternoon. Apple price at $254 per share, downward by 2.0 point this morning, and we're talking about negative 0.81%, and Tesla, a price level of $427 per share, gaining 3.71 points this morning, 0.88 this afternoon, 0.88%, and Microsoft at $509 per share, also gaining 0.4%, Amazon gaining, Meta gaining, Nvidia are gaining, while Visa are dropping in price this morning, negative 1.1%, and JP Morgan at $314 per share, upward by 1.25 points, 0.4 percentage gain. J&J are gaining 0.59%, P&J falling negative 0.18%, ExxonMobil dropping but not of a significant difference, and Alphabet also dropping. Goldman Sachs gaining 0.31%, Caterpillar are falling by negative 1.29%. Back to Africa, Nigeria, looking at food inflation in Nigeria. The chart we're about to see shows how much money one would need each month to buy the same food and non-alcoholic beverages that cost 100,000 naira in January 2025. And the value are calculated using the month-on-month consumer price index for food, which tracks changes in prices over time. Food prices have steadily increased in Nigeria this year. Based on the rebased consumer price index from the National Bureau of Statistics, the cost of a basket of food and non-alcoholic beverages rose about 18.9% between January and August 2025. Using January as a baseline, as you can see, this means that the amount of money that could buy a typical food basket in Nigeria increased by roughly 14% by August to purchase the same items, illustrating the erosion of household purchasing power due to inflation. Well, statistical outlook from January to August, looking at the impact of food inflation in Nigeria, as you can say, how the same value for 100,000 naira worth of goods and what the price is as at January 1st, what the price was, and moving further to August. At January, the same basket of food cost about 100,000 naira, and it kept increasing every year, rather every month. To February, it would cost 102,000, it did, and moving forward, 104,000 naira, and on and on and on, and currently at 114,000 naira. If you look at the permutations and the rise of the index, about 126.1 index level. Our cost of food in Nigeria increased 21.87% in August of 2025 over the same month in the previous year. Meanwhile, food inflation in Nigeria averaged a 14.13% from 1996 until 2025, reaching an all-time high of 40.87% in June of 2024 and a record low of a negative 17.50% in January of 2000. Still in Nigeria's oil production. Nigeria's crude oil production is increasing, reaching an average of 1.7 million barrels per day in July 2025, with a goal of reaching 2.06 million barrels per day by the end of the year. This rise is attributed to government intervention like cost efficiency measures, tax incentives, and a successful crackdown on crude oil theft, which have boosted investor confidence and increased production from major terminals like Avocados and Bonny. And now we look at the charts indicating Nigeria's oil production in millions of barrels per day from the first quarter of 2022 to the second quarter of 2025, according to the National Bureau of Statistics. The indication that comes with the first quarter of 2022 indicates a price level talking about oil production in Nigeria at 1.49 million barrels per day. It's slowed down. The red and dotted spots have shown the negative, the way it's falling in the next quarter and the next, but it's been back and forth, but currently back up until it got to 1.69 million barrels per day in August. Nigeria's crude oil production between the first quarter of 2022 and the second quarter of 2025 reflects a cycle of volatility followed by gradual recovery. In 2022, production struggled, dropping from 1.49 million barrels per day in the first quarter to just 1.2 million barrels per day in the second quarter, the lowest point of the period, before closing the year with a partial rebound. The following year, 2023, saw a strong recovery, particularly in the third quarter, when output surged by nearly 19% quarter on quarter, pushing production back towards pre-decline levels. In 2024, output growth was more subdued, fluctuating within a narrow range as Nigeria stabilized production despite challenges from pipeline issues and OPEC quarter pressures. Entering 2025, the sector gained momentum again. 3 consecutive quarters of positive growth lifted production to 1.68 million barrels per day by the second quarter, at its highest point in over 3 years. These trends suggest Nigeria may be consolidating gains from reforms and improved security in oil-producing regions, signaling cautious optimism for sustained output. Still in the oil sector, let's look at the world's top 10 countries by oil consumption. In 2024, the world's top 10 largest oil-consuming countries accounted for 61% of the global share. This jumped to 80% among the top 20 countries as overall consumption increased by a moderate 0.7% annually. And despite slowing growth and rise of green energy sources, oil continued to be the leading source of energy worldwide. The graphic shows the world's top oil-consuming countries in 2024 based on data from the Energy Institute. Let's look at the data. In 2024, the U.S. consumed 19 million barrels of oil per day, representing 18.7% of the world's total. Breaking it down further, approximately 70% of American consumption is from the transportation sector, followed by 24% of industrial use in areas like feedstock for plastic production. Meanwhile, residential and commercial use each make up about a 3% share. China ranks in second globally, consuming 16.1% of the global total. However, oil consumption per capita is less than a fifth of America. To partially make up for this, China relies more heavily on coal in its energy mix. Following next in line is India, covering 5.5% of world oil consumption in 2024. Unlike the US and China, which have seen oil demand growth slow in recent years, India is projected to be the top country driving oil demand growth through 2030, given the rising strength of its economy and its phase of economic development. And now to the euro area. Inflation expectations rise in August. Median consumer inflation expectations in the euro area, the eurozone, increased to 2.8% in August 2025, the highest in 3 months, from 2.6% in July. Expectations for inflation 3 years ahead were unchanged at 2.5%, while expectations for a 5-year ahead increased to 2.2%, the highest since August 2022. Lower income quantities or quantiles continue to report on average a slightly higher inflation perception and short horizon expectations than those in higher income quantiles, a trend observed since 2023. However, the broad evolution of inflation perceptions and expectations remain relatively closely aligned across income groups. Younger respondents aged 18 to 34 continue to report lower inflation perception and expectations than older respondents aged 35 to 54 and 55 to 70, albeit to a lesser degree than in previous years. Meanwhile, economic growth expectations for the next 12 months remain stable in August at a negative 1.2%, and expectations for the unemployment rate 12 months ahead increase to 10.7% from 10.6%. And now let's look at the charts indicating euro inflation rate. Inflation in euro, you've seen the ups and downs. As at September, just below 2.4 points rates, 2.4%, and October it went up a bit to close to 2.5%, and ups and downs, but went to a peak point of 3.1% in April and began to slow down just recently, August hitting 2.8%, indicating a twist of mixed fortune in the euros, talking about a cost of commodities just slightly being higher than it was previously as at September last year, and then the euro itself not strengthening enough the way it should be. Still in the eurozone, let's talk about Spain's second quarter GDP growth as it's revised higher. The Spanish economy grew 0.8% quarter on quarter in the 3 months to June 2025, up from a preliminary estimate of 0.7% and marking the strongest expansion in a year, following a 0.6% rise in the first quarter. Domestic demand contributed 0.8 percentage points to growth, while external demand made virtually no contribution. Household spending advanced 0.8%, investment surged 1.8% against 0.3% previously, and government consumption edged up 0.1%. Exports rose 1.3%, while imports increased 1.6%. On the supply side, all major sectors expanded except the primary sector, which contracted at 6.4% rather. Industrial output grew 0.9%, supported by a 1% increase in manufacturing services, climbed 1%, and construction jumped 2.3%. Year-on-year, GDP rose 3.1%, above the preliminary estimates of 2.8%, and compared to an upwardly revised 3.2% gain recorded in the previous quarter. The Spanish economy is expected to grow around 2.7% in 2025. And now to the market as steel prices weaken on prospects of EU tariffs. As steel rubber futures fell to around 3,060 Chinese yuan per ton today, a 2-week low, after reports that the European Commission plans to impose stiff tariffs of 25% to 50% on Chinese steel imports and related products in the coming weeks. The measure seeks to limit inflows and protect domestic producers as global overcapacity continues to pressure margins, while Western economies also aim to preserve strategic manufacturing capacity. Meanwhile, top producer China is preparing to cop new capacity to address excess supplies and weak prices. Just last month, Beijing ordered major mill to hold production as part of its pledge to tackle overcapacity in the ferrous metal. And now to the market, let's talk about the commodity markets, a price level of the commodity market. Commodity market indicates the rate of crude oil, price of crude oil at $65 per barrel, and upward trajectory, indicating the price going upward by 0.228 and a change of 0.35%. Brent, which represents Nigeria's price benchmark at $69 per barrel, gaining 0.15 point, 0.2 2%. And on the other hand, natural gas also are gaining. A gold price at $3,753 per ounce, upward by 4.21 point, 0.11%. And silver price $45 per ounce, gaining 0.06%. As we're set to close, let's look at the top 5 gold producing countries from 2010 to 2024. China leads global gold production with 380 tons in 2024, maintaining its top spot despite only an 8% increase since 2010. Russia has seen a 63% increase since 2010, reaching 330 tons, solidifying its position as the second largest producer. A global demand for gold has remained strong over the last decade, driven by central bank reserves, investment demand, and jewelry consumption. This table we're about to show indicates the 5 largest gold-producing countries from 2010 to 2024, highlighting shifts in output and global rankings. And while some nations have ramped up production significantly, others have seen notable declines. The data comes from the World Bank. Let's look at the charts and the data. China holds the top spots. China has been the world's leading gold producer for over a decade. In 2024, the country produced 380 tons of the yellow metal, up just 8% from 351 tons in 2010. And despite the modest growth, its dominance reflects long-term investment in domestic mining and refining infrastructure. A China state-supported mining industry also helps insulate it from global volatility. Russia and Canada has gained ground. Russia has boosted its gold output by 63% since 2010 and reaching 330 tons in 2024. This growth is driven by increased investment in mining projects and a strategic focus on building national reserves. Canada saw the most dramatic increase among the top 5 with a 98% jump in production. From just 102 tons in 2010, it now produces 202 tons. U.S. gold production also declined sharply. The U.S. is the only country in the top 5 to post a decline. In 2024, it produced 158 tons, down from 231 tons in 2010, a 32% drop. Environmental regulation, lower ore grades, and the closure of key mines have all contributed to this decline, pushing the U.S. to 5th place globally. But it's identical concerns within the context of world economy and gold production and the different markets, the ups and downs and the swings that comes with a market. It's a story of world economy. And here we draw the curtain in today's edition of Business 360, or rather, a world economy. We draw the curtain at this point. My name is Bladen Kim, and thank you for being a part of it, and thank you for joining.